All right, good afternoon. We're going to record this program. Good afternoon and welcome, everyone. My name is Eric Amodio, this year's president of the Connecticut CCIM chapter. CCIM stands for Certified Commercial Investment Member and is a global commercial real estate designation of around 13,000 professionals worldwide. Our chapter mission is to provide superior education, networking, and technology to commercial real estate professionals. If you are not a member already, I strongly encourage you to join our chapter by visiting ctccim.com. Also, before I forget, please mark your calendars for April 18 through 21. Again, that's April 18 through 21. Our chapter will be holding an updated CI 102 course at Goodwin University in East Hartford. This is the market analysis and site selection course, which is part of the 4-course designation series. No prerequisites are needed and all are welcome to sign up. Lastly, again, please note this webinar will be recorded and we will have a Q&A session after the presentation. Please submit your questions anytime through the chat box. Now, on to the main event. I want to thank you for attending today's 2022 CRE forecast presented by Mike Goman. Mr. Goman is a principal with Goman York and has over 40 years in the real estate industry. Mike advises tenants, corporations, institutional investors, and high net worth individuals regarding their commercial real estate investments, acquisitions, and development. So I'd like to turn it over here. Welcome, Mike. Thank you for putting this together for us.
Well, thanks, Eric, and I'm glad to be here. I'll share my words of welcome to the audience as well. The interesting times that we're living in, and hopefully this will be a helpful overview for you in that regard. So let me go ahead and share my screen here. Is that up, Eric?
Perfect.
Okay, so we're good. We've called this the changing commercial real estate landscape, just an industry overview. Eric gave you a little bio on me, but I want to touch on a couple of things because I think it's relevant to the perspective from which we go at these kinds of discussions. So I run the advisory side of our practice here at Goman York. Tom York, whom a number of you probably know, runs the brokerage side. I spend virtually all my day talking about commercial real estate with a wide range of clients, and I've listed a few of them here. Municipal and government clients, we're currently doing around 40 municipalities, advising roughly 40, a little over 40 municipalities, where we are either the on-call real estate advisor or on a project basis. Government agencies, we do a lot of work, for example, with Capital Region Development Authority, CRDA, here in Hartford. We do a lot of work for the Connecticut Department of Transportation Rail Division, a number of other agencies along those lines. Institutional owners and investors, that pretty much is a group of either private colleges and universities or large healthcare systems. In some cases, it's tax credit investors who ask us to, they're institutional large companies, and they ask us to do some analysis on a tax credit deal they're looking at. And then, of course, with lenders and developers, we do a lot of market and financial and fiscal and economic impact studies for projects that these groups are either looking at or are planning to do. As Eric said, more than 40 years, I unfortunately have to admit to that. Doing this kind of work, and roughly, approaching 60 million square feet. And actually today it's about a $5 billion portfolio that I've worked on. A lot of very active in ICSC over the years, particularly on government relations and in education. And then I've listed here the states that I'm licensed in and some other things that I'm involved with. So I hope that kind of sets the stage. And the reason I wanted to go over that briefly is that what you're going to see in a few minutes really is sort of our perspective as we talk to our clients, as opposed to looking at it purely from a brokerage standpoint, for example. So I hope that helps frame this. And I'll point out that's an old picture. I don't have as much hair as I did when that picture was taken. So we'll do the industry overview and some predictions and some things to think about with respect to what's going on in the industry and projects you may be involved with. And then I'm going to share with you briefly on a couple of slides the the kind of advice we're giving to municipal clients and some of our business clients. Hopefully by the time we're all done here, we'll have a little bit of time left to do some Q&A. So, we struggle with what to call what's going on out there. We sort of settle on sea change, but you could use a lot of metaphors for what's happening. But no question that we're in this market that has really turned a lot of the sectors on their head to some degree, more or less. So what I've done here is broken down by sector here. We'll have just a brief conversation about each one. So in the office sector, we monitor data from the card entry and key fob entry companies that provide those card entry systems to office buildings in downtown central business districts in a bunch of different markets. We get data every Friday on the occupancy, physical occupancy in offices in the top 10 office markets around the US. And we've been monitoring that data for years. We spend a lot of time on the data side and the work we do. And, it's surprising. The central business districts are still running around 30% physical occupancy. So, in a market like Manhattan, I mean, to have 70% of those buildings sitting empty is economically, for our municipal clients, that's a devastating impact. And we're seeing that right across the board, certainly seeing that here in Hartford as well. We're seeing changes in the design of the offices, introducing a lot more flexibility. No question that work from home is going to continue post-pandemic. I was talking to a group that we do some work with. They have about 100,000 employees in 70 countries around the world, use a lot of office space, and they're assuming that roughly 30 to 40% of their workforce is going to be working from home for the foreseeable future. Now, when you think about that, if you're an office building owner, that's pretty dramatic. I mean, it's, most of as time goes by, what that will mean is a decline in the amount of space that they are using. The question is, will that space be backfilled enough to absorb it? The concern we have when we're talking to lender clients, of course, is, if you have a market like Hartford that has 20% vacancy and has had for a number of years, and that goes to 30 or 35% vacancy in the next 5 years, that's a real problem. Obviously, these buildings weren't underwritten to be at a 30 or 35% vacancy level. So the impact of that is the full impact of work from home is yet to be felt, and we'll see that over the next coming years. When we talk to our clients out there on the business side, large corporations side, when are they thinking that they'll see a normal occupancy level in their office spaces? And I mean, you get answers all over the map from never to sometime this spring or this fall. We don't know. We think that's reasonable to assume that we'll reach some kind of stabilization in 2024, but who knows? In terms of the office sector, new development, it's really dependent upon net new job growth. Florida and Texas continue to ride that wave. We monitor Dallas, Fort Worth, for example, and Dallas has historically been adding about 100,000 net new jobs every year for years now. And that 100,000 net new jobs is what drives the office sector in Dallas, growth in the office sector. And the last comment here was I was talking to a mortgage finance company that does a lot of office financing in the major markets. And his comment to me was that he just can't finance a B or C office property to save his life. If he's looking at a refinancing in his existing property, they just don't want to touch them right now. Retail, it's kind of a tough story there. A lot of closings in the department store merchandise categories. However, a lot of openings and generally broad-based strength in the general merchandise and home improvement and grocery categories. Sales have been very, very strong. The holiday season actually in last quarter of last year ended up pretty well at an 8.5% year over year. You can see the breakdown between in-store and online. Of course, online keeps growing. And last year, the National Retail Federation numbers were roughly 21%. I think the average prediction is that it'll reach at least 25% the next year or two. One notable change is that the holiday season shopping started and has been starting much earlier each year. So it hasn't been the Black Friday rush. The holiday shopping is actually starting before that. And in fact, the last couple of weeks of December were comparatively slow, which was surprising. So people, I think, were scared by the shortages, the stories of the shortages, wanted to get things done, and that showed up in the velocity of sales over that 8-week or 9-week period running up to the Christmas. We'll see if that happens again next year. Restaurants, a lot of concern about local restaurants. Roughly a third are expected to not reopen. These are the local guys with low liquidity, went into this with low liquidity. The local guys in the casual dining segment, of course, has been hit very hard. The QSRs, the quick service restaurants with drive-throughs, I mean, they're doing great. They've picked up a lot of business because people want to stay in their car and pick it up at the drive-through window. We're going to talk a little bit about more of the impact of that in a minute here. But they're also struggling in restaurants with labor and shortages and cost increases, and we don't see that changing for the foreseeable future. A lot of that workforce has simply left that sector and found other jobs, and whether or not the sector will be able to backfill those changes in employment is yet to be seen. In the hospitality industry, of course, they took it on the chin big time in 20 and 21. The average resort hotel has seen some recovery as people want to get back out and start to enjoy themselves again and do some things with their family other than sit at home, watch Netflix. The business hotels, however, that roadside interchange, interstate highway, business hotel, those things are still suffering with low revenue per average room and low occupancy levels. We see that continuing until business travel picks up again, and how fast that recovery will happen, who knows. Certainly the flights that are out there on air travel are full, but when you look at the number of flights that have been canceled by airlines across the globe, it's dramatic. I mean, the overall capacity has come down significantly. They're operating, I think, again at reasonable levels, but how quickly that will come back up to the normal flight schedule is anybody's guess at this point. Single family development, just the standard for sale stuff. Production's been down for a while now, and it sort of follows the population growth. We certainly see that here in Connecticut versus say in the 80s. When Connecticut's housing production was 10,000 units a year or more, and dropped off to under 3,000 and 4,000 units per year in recent years. It's stabilized and started to grow again a little bit. Where we go from here, I think is going to follow Connecticut's record in terms of economic growth. They're struggling. That business is struggling with high prices and low supply, and of course interest rates going up, and we'll chat about that for a second. The interesting part about the single family residential development, though, is that SFR growth, the single family rental growth, just huge growth in the southern markets. Blackstone exited the market back in 2019. I thought that was an interesting change on their part. To me, it felt like a vote of lack of confidence, if you will, in the market, but they have since roared back this year with a $6 billion investment buying up some companies, and they're now owning something in the order of 17,000 single family rental homes. In addition to Blackstone, you've got the big guys like Brookfield and JP Morgan Asset Management, Rockpoint. They've all come back in a big way. The expectation is that this next year we'll see about roughly 100,000 new homes built in this year to satisfy the investment demands of that market, and roughly 30 billion in debt and equity that came into the market in 2021. We think that will continue to grow. And again, a quote from an industry professional, he said, look, this stuff just offers the best ROI of all property sectors. Now, the interesting thing about single family rental housing to us is, what will that start to show up in any quantity here in Connecticut? And I think it's unlikely that it will. I mean, a big subdivision here in Connecticut is 30 homes. If you go down to Florida, a small subdivision is 1,000 homes. In a lot of the central Florida markets now, we're seeing 3,000 and 4,000 home subdivisions coming out of the ground, and they'll be built in 2 years. So, you know, are we going to see a lot of single family rental activity here in Connecticut? We doubt it. You know, we may see some of it, but nothing on the scale of some of the southern markets. Multifamily development, a real bright spot here in Connecticut, just all kinds of stuff going on there. We probably do 30 studies a year right now on market and financial feasibility for proposed multifamily development projects. And we see just continued growth in that. These are the sectors, the socioeconomic segments that are going into these properties, the empty nesters. That's the people that, you know, like me, whose kids are gone and they don't want to maintain a house anymore, but they want to stay in their community and they can afford and will pay for an upscale environment. The double income, no kids, 2 young professionals that have college debt and no children. Newly singled, which is a nice way of saying divorced. They are a big part of the market. We're seeing roughly 30% of some of the projects we've studied being occupied by newly single people in their late 40s, early 50s, earning good money, but have just gone through a divorce. Kids are gone, don't want a house, like to travel, and the lifestyle appeals to them. And then, of course, the recently retired, that's people that, you know, left the workforce, but are in a transition before they might end up in a senior housing environment. They like the lack of maintenance and so on that they can get when they go into these apartment projects. So, you know, look, it's very much in a lot of the markets that we work in, it's a very new product. A lot of the housing stock that in the markets, the municipalities that I mentioned earlier that we're serving, the last significant apartment project in most of those towns was built in the 1980s. And they're old, tired projects without the amenity-rich environment that the new projects are offering. So, you know, we are seeing with the lack of growth in Connecticut, population growth in Connecticut, the B and C apartment projects are going to be under pressure as more of these high quality, recently built, newly designed multifamily residential projects open up. So we'll see what that means. There may be opportunities there to do some conversions of those older properties. I always get asked about condos. You know, it's really not a market that we study much, and probably because we just don't see much activity in it. I'm still waiting to run into somebody who's actually made money on a condo if they bought it and sold it in recent years here in Connecticut. I know it's a strong market in the South, but we just don't see a lot of activity, and we're not expecting to see much here in Connecticut going forward. Self-storage, I mean, really strong, lots of growth, very much a movement toward climate controlled versus the old, you know, unheated, unlighted, outdoor access garage bay kind of operation. The climate control seems to be where the activity is in the municipalities and the applications that we're seeing filed with them for storage projects, very much a focus on the climate control. And then warehouse logistics, this is a story I probably don't have to tell you, just huge demand. You know, we track a couple of databases on that, and you know, they vary, but the one that we follow and think was the most credible is predicting roughly 300 million square feet of new high bay modern warehouse logistics space will be built in the US this year. You know, it varies in sizes, everything from that new Amazon building that many of you probably seen up at the Highway 20 entrance off of 91 into Bradley Airport, 3.6 million square foot Amazon warehouse. That's the high end. That'll be the highest or the largest warehouse building in Connecticut, and it's about to be completed. But we're also seeing, you know, the smaller buildings, the 35,000 foot conversions of old big box or baby box retail space into some form of warehouse and logistics. As we look around, the refrigerated and cold storage is a market that seems to be really picking up momentum up here. It's been busy for a long time down south, but it really seems to be picking up momentum here. So we're expecting to see more growth there. This is a slide that was put together for another reason. It's maybe a little hard to see, but this is simply kind of looking at north central Connecticut and kind of plotting out the major distribution centers. These are between 100,000 square feet and 3 million square feet, not retail locations. These are just a purpose-built product. But it gives you a sense of just how much activity we've seen here in north central Connecticut in this warehouse logistics market. And lastly, engineering construction, the non-residential piece of it was slow for 2021. The educational, the office, transportation, healthcare, commercial facilities saw the largest year-over-year decline as of July 21. On the other hand, residential saw a pretty significant increase over 19 with 1.5 trillion in July versus July 2019. So a lot of residential, but slower in the non-residential in the last couple of years. However, the outlook is that both residential and non-residential are coming back in a big way, partly driven by the $1 trillion that the feds are investing in the Infrastructure and Jobs Act that's coming out, Investment in Infrastructure and Jobs Act that's out there now. We're going to continue to expect to see the material and labor shortages that people have been seeing, and of course the price volatility as well. But the E&C industry is coming back in a big way, no question. So a little bit of a summary, W-shaped recovery. There's a lot of ups and downs. For example, specialty retail is still in trouble, but general merchandise and home building products are very strong. So we're going to see a lot of that kind of tale of two cities, if you will, in a lot of these sectors. I think the duration of this is much longer than anybody thought going into it. And I think it's still probably 18 months to 24 years that we're going to, or 24 months, pardon me, that we're going to continue to see impacts of this. In some of these sectors, I don't think we've fully seen the impact of work from home, for example, in office, and some of these other things that are playing out now. And it'll be interesting, very interesting to see. I mean, we study this all the time, and there is definitely a trend in the case of office that work from home is going to be permanent, and the impact of that will take a few years to play out. That's forcing a lot of businesses to rethink their business model. And we were talking to someone the other day about this, and we were joking that long-term planning now is a month. You don't know what you're going to be dealing with, but we think long-term planning right now is kind of trying to look 6 months ahead, and continue to keep the storm covers on. Transactional activity, we saw a lot of deals that were put on hold, but it's returning now. Very concentrated in specific sectors. The pricing gap was wider for a while there. We're starting to see that narrow a little bit as sellers are beginning to understand what they're going to be faced with. A lot of leases that it's definitely become a tenant's market. And the focus for activity is really, as it tends to do, focus much more on the strong markets and the best tenants and the best properties. On the sell side or buy side of real estate, commercial real estate, very much a focus on properties that have a real strong and reliable and proven NOI, and look a deep dive into the tenancies to see if they are tenants that are going to be able to survive the changes in the market that we're experiencing. Again, a lot of focus on industrial and multifamily, and we think that's going to continue on the transactional side. Consumer behavior is definitely changing. These are just a few little points around health and safety staying in the forefront of the consumer's mind. Delivery really becoming part of the retail landscape. When you see Walmart jumping in with both feet into delivery, that's a good sign that this isn't a passing trend. The BNPL, the buy now, pay later, that retailers have rolled out in the last year, 18 months, that business is really growing dramatically, and the largest retailers have really embraced it, and we think that's going to be with us for quite a while. Interestingly enough, we're still seeing or hearing reports of stockpiling. A lot of empty shelves. Part of that is the supply chain issue, but part of it also is people sort of still wanting to kind of load up on basic commodities for their home and family. And when that starts to taper off is anybody's guess. The BOPIS, the buy online, pick up in store, the curbside pickup, that's also something that's going to stay with us in retail for the foreseeable future. And in fact, we think that that's going to expand probably dramatically. We're already seeing big national tenants who are changing their store prototypes to really focus on becoming very efficient at doing that curbside pickup. Curbside pickup, ordering online and picking it up on the curb is far less expensive than delivery. Delivery is just a big loser for a lot of these guys. They sort of feel like they have to do it, but it's problematic in terms of its logistics and its cost structure and so on. So the buy online, pickup in store, the curbside pickup, I think we'll start to see major retailers that'll have prototype stores, which will include enclosed drive-through lanes, sort of a large version of a bank drive-through, sheltered from the weather, immediate access to your order right off the side. No one will have to get out of the car, and we'll see store designs that will include that drive-through lane where people can just literally go in, scan their QR code on their phone, and the attendant will load up their trunk with their purchases, and they'll be back out on the street. That's going to be a big change, and we're already starting to hear from some of our retail folks that they're well down the road in those designs. So debt and equity activity, this was really looking at the last quarter of 20 versus the last quarter of 21, and focused on commercial and multifamily. So really the year-over-year activity between the two quarters, 20 and 21. And you can see, I mean, it was a terrific year for the mortgage finance industry. Virtually every sector except healthcare saw significant increases, from 20 over to 21. So I think that's a good sign that we look at that and assume that that's a really good sign for new activity. Again, talking to some of the market, some of the people in the market that are in the mortgage finance business, the quote was, just an unbelievable and unprecedented amount of capital that's out to be deployed. So there's going to be money available, but you're going to see the focus on these three things that we bulleted out here. Very intent investing, again, kind of a return to quality, which we always see when the market senses uncertainty. The money is going to go to the core properties and the core markets and the high quality properties in those markets. Very much focused on industrial and multifamily, some office, but that'll be very focused on life sciences. Although even some of the latest data we've seen, life sciences in some markets has started to slow down actually. And it's the availability of debt for B and C properties is definitely narrowed, and we see that continuing for the foreseeable future until we see how some of the office and retail sectors particularly stabilize over the next couple of years. Much more interest in existing where you've got that reliable and sustainable NOI I mentioned earlier. And of course, a lot of pressure on this issue of increasing costs, and it's getting harder and harder to make projects make financial sense and be able to put together a pro forma that can attract the kind of debt and equity that it needs. Interest rates aren't going to help that. Changes in interest rates aren't going to help that. So what are we watching when we talk to our municipal clients? These are the categories of the sectors, if you will. The business hotels, as I mentioned, conference centers, business conferences really haven't come back yet. Probably won't come back maybe until the fall or later. The local restaurants, we talked about those guys and the specialty retailers and companies tied to travel. All those are immediate concerns, businesses that you want to be paying attention to. Midterm, we talked about this, the office building, the impact of work from home on their occupancy. And then, of course, what's happening in the B and C retail properties. Here in Connecticut, of course, we've seen a significant erosion in the large regional mall properties. Everything from the shops at Buckland Hills going into receivership to the properties that have sold, some of the properties that have sold recently for $10 and $12 a square foot. I think we're just going to see that. That's not something exclusive to Connecticut by any means. We've been kind of predicting that for years, going back into the early 90s. The reality is the US just got overbuilt on retail. If you're a municipal client, we're asking you to be very careful about your assessed values of commercial real estate because of all these factors that we've laid out. The value of office spaces and retail spaces is under assault, and we're seeing declines in those values, significant declines in those values. Major office property here in Hartford declined from, I think, 110 million it was about 5 years ago in its valuation down to 82 million recently. So big decline in value, and that's of concern to municipalities. Fortunately, in a lot of these municipalities, the corollary is that the value of single family housing has gone up dramatically. So the grand lists are being shifted around a little bit with the single family residential taking up a greater portion of the grand list. The other thing we're saying to our clients is, have a look at your existing stock of commercial buildings and pay particular attention to anything that's older than 40 years. I mean, these are buildings now that are on their second roof, second parking lot, full-blown replacement of all mechanical and electrical systems. These buildings are going to require a lot of investment, and will the market support that kind of reinvestment is the question. And for a municipality, if they're concerned about where the commercial real estate sector is going. So again, a lot of this stuff started back in the 90s. We had too much retail and office square footage in a lot of these markets. COVID's just made it worse. Work from home's accelerating it, and the marginal guys are going to be in the most trouble. This is a chart that some of you may have seen before. This is just looking at the major malls around the country. And I think we can leave it that the big issue is that summary down at the bottom. There's roughly 1,900 centers that are over 400,000 square feet that are classified as Class C or worse. And those are the centers that are in big trouble. And we're going to see a lot of those. We already have. We're going to see continued erosion in that market. And that's going to be opportunity for some people that have ideas to convert them to something else. We've been very active in that world in the last 2 or 3 years. But the reality is, if you look back to retail square footage on a per capita basis, the US at its peak had about 24 square feet of retail space per capita. And the next closest market was Canada at 12 square feet, so half. And Western Europe was around 8 or 9 square feet of retail space per capita. So this isn't something new. We built this stuff a long time ago, and we're living with it now. So it'll be interesting to see what happens. Specialty retail, that's the small retailers, the jewelry stores, the shoe stores, the high-end apparel stores. We're going to continue to see anemic sales growth in those areas, despite the fact that building products and general merchandise sales have increased fairly dramatically. That specialty retail segment is really suffering. That's going to have an impact on a lot of downtowns and a lot of mall properties, particularly. They have difficulty financing, rental income just being flat or declining, appraised values moving down. We're spending a lot of time agonizing over the FOMC dot plot and what it's predicting about increasing interest rates. And generally the consensus of the dot plot seems to be around 200 basis points in the next number of months, certainly before year end. And that's going to change the financial picture for a lot of these properties out there. They're not set up to be dealing with interest rates of say 6.5% or 7.5% or more. So we'll see what the impact of that is. But there's no question the Fed has decided that the economy needs to be cooled off a little bit, and they're going to use interest rates to do that. Just how much and how fast is the question. So stay tuned on that. I mean, that's going to be a story that'll start with the next FOMC meeting in March, and we'll see what they come out with. Again, focus on A markets and properties. We are expecting and predicting an increase in foreclosures in both, particularly office and retail. The reality is that unless the market is growing in terms of population, job growth, we don't see new retail or office development of any scale really happening. No tenants, no money for that. Not to say that if you have a tenant in tow and they want to be here in this market, I mean, that'll work. But anything that's speculative or mostly speculative, we think is going to be a real struggle. A lot of activity though in the convergence side of both retail and office, and that's a webinar we could do just on its own. Talk for an hour about what kind of conversions are out there, but we've seen everything from casinos to residential, all kinds of uses, and I think we're going to see that continue. Building design changes, we've talked a little bit about that. Much more open air features, much more flexible layouts in these offices. Much greater increase in suburban properties and lower interest in urban, CBD properties. That's an interesting one. One of the data points that we use is geo-fencing of cell phone data. So in other words, looking at how cell phones move on an anonymous basis in a market on an hour by hour basis. And if you'd looked at that data back in 2018, you could very easily see the work from home traffic, or pardon me, very easily see the drive to work and drive to home traffic patterns. Now, I mean, when you look at that data, there is no rhyme or reason to it. What it looks like is that these cell phones are staying put in their suburban homes, going out at lunch to buy groceries or have some lunch and returning to their home. So you can't predict it and say, gee, on this road at 8 o'clock in the morning, everybody will be driving eastbound as they go to work, and at 5 o'clock they'll be driving westbound as they come home. The cell phone data clearly shows that those days are behind us. Whether that'll come back is anybody's guess. But it's really turned our analysis, particularly in our bank branch business, really turned our analysis of traffic patterns and behavior on its head, and we're expecting that to continue. Horizontal mixed use, not much vertical mixed use. We're working on a project now in Florida for a client that was originally planned to have some mixed use going vertically, and the market's just not going to support that. So that project is being redesigned. A lot of drive-throughs, and we're going to see, for example, I think it was Panera Bread rolled out just the other day, a new prototype that will have no dining in store dining at all. It'll just be a drive-through pickup facility. And I think we'll see a lot of the fast food guys, the QSR guys, go that route. I mean, if they can keep people in their car and not have to maintain that dining room, I think they'll be quite happy to do that. So we're expecting to see more prototypes along those lines. And what that will mean is more drive-throughs as well, not just a 2-lane drive-through, but a 4-lane or a 6-lane drive-through for pickup. And there's a lot of work being done in that area as we speak, and we think that's going to continue for and develop a lot of new delivery-only prototypes. Building technology, of course, prop tech, you've been reading a lot about that. That's going to continue to impact as companies find ways to increase the security of their building and improve the health of their building. So likely future, tough leases, tenants market, except in the A markets. Much more focus on experiential retail. So the way that plays out is, shopping really isn't seen as an interesting kind of pastime anymore by the average consumer. The average consumer now is more inclined to say, teach me, feed me, entertain me, give me something to do with my friends. And that's the experiential retail. So I think we'll see a lot of the sort of merchandise-driven retail space be converted into this experiential retail. And there's a long list, everything from golf simulators to hockey rinks and everything in between, about what you can do with some of these spaces in this search for experiential retail. Lots of improvement still, lots of growth still in the gas and convenience and auto parts and dollar store. Dollar stores by far have led the charge in terms of new store openings the last number of years, and that's probably going to continue. And of course, cannabis is now on the market, and we think that's going to be a growing area. QSRs and the fast casual restaurants, that'll be a source of growth as well. And we think we'll see new formats in some of the big box guys. We're already seeing some of that roll out and be circulated among industry people now as to, where can Target or IKEA or Bloomingdale's or some of these other guys, can they effectively do a 50,000 foot presentation versus say 128,000 square foot presentation. So we'll see. That could be a real engine for growth for a lot of these retailers. And of course, just this last point is sort of the interest rate discussion. We think we'll see some zombie projects and zombie developers as interest rates really start to jump up. Really is going to be a function of how much those rates go up. Clicks to bricks. I mean, don't assume that the online retail world is going to take over the brick and mortar retail world. At a minimum right now, we're still looking at 70 to 75% of retail sales being done in a store environment of brick and mortar. And one of the interesting things that we found is that when a retailer opens a store in a given market, in a new market, their web traffic and web sales from that market actually jumps, and the data is showing about 40%. So of course, Amazon is jumping into brick and mortar stores. Guys like Warby Parker that were online only guys, they're jumping into brick and mortar stores because they work. There'll be fewer locations than say they might have been back in the 80s and 90s, and they might be smaller and a little different, but they are really, as we've said here, these stores are billboards. They can also be fulfillment centers and showrooms, but for the most part, they tend to be billboards. They're great advertising that drive people to the website to buy. And they may not carry the full inventory in the store, but you can get it online. And we're going to see that in a big way, I think. Commodity transactions we'll continue to see online. People don't want to shop for big, huge packages of toilet paper and paper towels if they can get that delivered or they can pick it up curbside. They're not going to pick up a cart and fill up their cart in Walmart the same way they used to. So brick and mortar is still with us. In locations more important than ever, and making the location interesting and remarkable is really critical. As a side note, we're seeing a lot more of retail particularly align themselves with some kind of social cause as a way of building goodwill with customers, and that makes sense. So redevelopment opportunities, you got to look at the research. What's the market telling you about where the opportunities are? We spend, as you probably gathered, a tremendous amount of time in that space, looking at what's going on in all these markets that we're doing work in. A lot of conceptual planning now, and different than what it used to be. A lot more pre-development work, pre-application, pre-development work with the community. Much more of the better developers out there now are much more inclined to work on a consultative basis with the community, going in early and soliciting support. And communities are responding, not all of them, but certainly here in Connecticut, we've seen a pretty dramatic change in the mindset of a lot of Connecticut communities toward growth. And there's much more of an acknowledgement that this sort of flatlined economy is not working, and that things have to be changed. So the highlight here, though, is, if you're going to do this kind of redevelopment story, you got to be able to buy it cheap. And, we're not talking about 50 or 60 bucks a foot. We're talking about $8 and $10 a square foot that you can buy these properties for. We looked at a property recently in South Texas that a few years ago sold for 80 million, and the bank owns it now, and it just got sold for under 8 million. So we're going to see those kinds of changes, and therein will be opportunities. Here in Connecticut, it's still going to be in the apartment business. As I mentioned earlier, a lot of old stock and a lot of good demand for these upscale amenity-rich projects. The job growth is an important piece of it. But pay attention to the transit corridors and nodes of food and beverage concentration and recreational opportunities. Those help drive lease up activity. The markets that we think have some real promise right now, certainly Groton, New London, with the employment at the sub base and suppliers related thereto, is driving it. Fairfield County continues to be strong, and in fact has seen some strength come out of the movement from Manhattan, people relocating from Manhattan as a result of the COVID changes. Hartford, we think, is still a strong market, particularly in these two areas, apartments and industrial. And then Naugatuck Valley, for the people that want to get out of Manhattan and move up but can't afford the Fairfield County pricing, or companies that move out of Manhattan and relocate to Fairfield County, and their employees are going to pick a place in the Naugatuck Valley. So some good stories out there. Industrial, of course, nothing new for you guys. Highway and transportation nodes, available labor, and around similar uses, because that tends to drive the labor pool opportunity. Conversions are going to be big here in Connecticut. We've got a lot of old buildings here. And here's just some thoughts on it. We've seen, hotels and office being converted to housing, retail, all kinds of things that people are converting these things to, and only limited by your imagination, really. But in retail and the redevelopment, the two areas that should be focused upon are food and beverage and arts and entertainment. So if you're looking at a retail project and you're looking at how you might redevelop it, unlikely you're going to get specialty retail and kind of what we used to be able to do in the 90s. It's just not going to happen. So the two areas that are seeing growth are food and beverage and arts and entertainment. That's sort of part of the experiential retail that I was discussing a minute ago. Other conversion opportunities for older retail, obsolete retail, last mile logistics, co-working spaces, and in some cases, the ability to convert it into some form of rental residential. Out-of-state buyers. I mean, we get a lot of questions about what's going on with that. No question, we're going to see continued interest in Connecticut properties by out-of-state buyers, primarily because and many of these are coming out of the New York market or similar major metropolitan markets. And the pricing for what they can acquire properties here, the pricing is low by comparison to what they're seeing in their home markets. And there's less competition. We're working with a group out of the South that's in a very active market. And the question we asked them is, why would you come to Connecticut? And their response was, everything they look at in their home market has 10 or 15 developers chasing it. And the pricing gets crazy and the competition, you know, every property, every project that gets developed has 10 or 15 competitors to it. So they like the maybe slower growth or no growth markets, but they like the opportunity that they see here. And they see an opportunity, particularly in that residential market where, and industrial, where replacing those old products, old residential, old industrial with new modern products is the answer. So they're not expecting growth in population or jobs, but they're looking at the market and saying our product is going to be much better and we'll be able to fill it up that way. But going into that, you know, our advice to some of these people that call us is, you know, if you're coming in, come in with liquidity because it's going to take time, and come in with or be prepared to develop a very well thought out plan. If you want to get the support of the community, you need both factors. The communities are smart on these two issues, and they're going to want to see that you've got the liquidity and you've got a plan that makes sense. This we threw in just because it's kind of an interesting slide. This was an enclosed regional mall where we were hired to help with the master plan redesign of it and conversion. So we took the roof off, took the first line of columns out to widen it out. We could put streets in. It shallowed out the depths of the stores that were there. We took down a lot of the square footage, or we recommended to our client that they take down a lot of the square footage. It had to be smaller and it had to be outdoors, and it's mostly food and beverage. But you know, they're underway with that. Looks like it's going to work, and I think we'll see more of that kind of conversion. So here's just, I'll share with you a little bit of the advice we give to communities on these issues. And you know, I'm not going to spend a lot of time on this, but you know, we want our communities to be proactive and not wait to respond to changes in the marketplace. If they've got a troubled mall, don't wait till the mall owners come to see them. Look them up, talk to them. If you can offer help or support, do that. You know, look at your zoning and permitting criteria and the processes. And the mantra that we're using, and some of you have probably heard me say this before, is make your zoning and permitting process swift, simple, and certain. It shouldn't take a year to get through the process. Shouldn't involve 20 different presentations to different boards and commissions. And if you've got discretionary language that allows you to turn down an application because it doesn't fit the character of your community, or the commission members think that they don't see the need for the use, those are not objective standards. Remove those from your criteria. And if you can do these three things, make it swift, simple, and certain, we can bring people with money to your market, and they will be in a position to look at opportunities. Be prepared to utilize incentives. The reality is, for a lot of the projects that are out there right now, the available rents don't justify the cost, which means it wouldn't happen. The way to close that gap is the community has to participate, and they can participate either through tax increment financing or a tax abatement or a tax incentive program of some kind. Lots of different tools. So we spend a lot of time working with our communities on those, but they can be very effective at restarting investment interest in some of these communities that haven't seen any for a while. Also recognize that the world's changed. I mean, what you thought you might have got in your community in the early 2000s or even 2016 is probably not realistic anymore, and you need to change your outlook. If I have one more community tell me that all they need in the town is a small Nordstrom, I'm going to leave the business. There's no such thing. They have to get realistic expectations, and if they do, it'll work. And then be flexible. I mean, there's so many changes going on and so many opportunities. Affordable housing is on the lips of every community that we work with now. And in order to start to see increases in the availability of affordable housing in some of these communities, they have to learn to be much more flexible and allow things like ancillary housing and changes in use. Other things, you know, create resources around research and data. Think like a property owner, which means to us, you know, get out into your downtown on Monday morning and make sure that your downtown street looks like the mall looks on a Monday morning. In other words, clean, tidy, trash picked up, everything done, anything damaged, fixed and so on. Run it like a property that you own, like a property owner would run it. Work with the local groups, EDCs and chambers of commerce. Think about if you have surplus assets, old schools. We've done a lot of work with communities on helping them dispose of old school buildings, surplus school buildings. Don't focus on what price you can get for the old school building. Focus on what tax revenue will be created once that old school building has been renovated and brought back online. And those numbers are dramatic. I mean, we regularly go through this discussion with towns where they think an old school building is worth millions, and we tell them it's basically worth zero. If you can get somebody to redevelop it, and that building will start paying 100 or 200,000 a year in taxes once it's converted to a productive use, that should be the focus. And most communities get it. We just need to point it out to them. And then the value of halo businesses. I mean, for too long in a lot of Connecticut communities, the municipality has looked upon a big employer in town as just part of the town. And I mean, that's got to change, and it is changing. If you've got a big employer in your town, whether it's a big insurance company or big manufacturing plant, get out there and talk to them, build a relationship with them, understand that they give your town this halo, as we call it, of attractiveness and credibility to other investors, and protect that. Don't wait until they call you and tell you they're moving to the South Carolina market or something. Keep talking to them and show them that you appreciate it. Some quick slides on business. Wow, we ever get a spelling wrong on that one. For advice for business owners. Look, this is for all of us in business. Omni-channel, this hybrid between personal contact and online contact is definitely the future. Whether you're retail or you do what we do, you really need to stop thinking about it in terms of channels and really think about, how are you providing solutions? How are you making it easy for people to use your services, and how to make it simple to do this? The reality is, and this is an age-old trend, that people are going to use what's most convenient and what will help them get their job done. Now, whether that's online or in person, it doesn't matter anymore. Use whatever is the most efficient. We hear a lot of companies that are really moving into online and so on. That's great. But the reality is, it just should be part of what you're doing. Having said all that, if you're running a business, think of your platform in the context of being mobile first, because everybody nowadays is doing so much on their phone or their tablet. And as a sort of foundational platform for how you operate your business, you should be very strong on that mobile platform. And again, I'm not going to read through all this. The reality, though, is you have to have both. You have to have that personal contact, whether it's in a store environment or you going to see your clients. You have to have that personal contact as well as that strong online presence. They go hand in hand. What we have found, and we see this again in our bank business, the banks that moved to a very heavily online presence suffered. What happened over time was that their clients became less engaged with them. And that's not good. I mean, typically bank customers are what we call very sticky. They don't move very often. But banks that really moved heavily into online and sort of treated their branches as yesterday's news started to pay for it. And so the idea is you got to be strong in both of these segments. The customer data that you see about online, their feeling about online, is that it's the least satisfying experience they have when they're dealing particularly with retail businesses. So that should raise a lot of warning flags. Digital just cannot replace. It can help and it can supplement, and it can be in a pinch. It can be very efficient when somebody needs an answer quick, but don't think it'll replace what you're doing in terms of your customer contact. So structure for digital, definitely, make sure you've got that running really strongly, but don't doubt the value of having an office and being able to invite a client into your boardroom and do a presentation to them in person. Still can't beat it. So some quick summary on a few points here. There will be good locations available at lower cost in virtually every sector of the market, with the exception of maybe industrial, certainly in office and retail. We are going to see a very much an emerging demand for new products and services, some that we don't even know exist yet. But whether it's virtual reality or some of the things I've talked about, QSRs with no dining area and drive-throughs only, be ready, because this is a sea change, as we started out saying, and those that can kind of stay ahead of this will benefit from doing it. Capital is out there, very attracted to new opportunities and ideas. The blind investment deals that we saw in the last few years that kind of tanked, they were an indication of where the market was headed. We're not going to see that sort of blind investment that we saw a few years ago, but we are still seeing that appetite for those new opportunities and ideas. The headwinds are going to be the interest rate environment, and we're all paying a lot of attention to that. So many of you, I guess, have lived through these cycles. It's not the end of the world. There's always opportunity in this. I could tell you story after story of people that saw opportunity in a down cycle and bought a lot of property and rode it to the next top of the next cycle and did very, very well. Be careful with this stuff. I probably don't have to tell you that, because at some point, every one of these waves, these cyclical waves, breaks at some point, and you don't want to get caught on the downside of that if you can. So, Eric, we got any questions? I ran along here, but I'm happy to take.
Oh, no, you're good. We got a minute here. Before we jump over to the questions, I do want to just give a shout out and a thank you to all of our chapter annual sponsors, without whose support, none of these programs would be possible. So please do reach out to these sponsors, give them some business, show them some love. Savings Bank of Danbury, Cohen Resnick, Community Investment Corporation, Newtown Savings Bank, BL Companies, RD Cinto, Guilford Savings Bank, H. Kulak and Son Construction, and Dime Bank. All right, we'll jump over to the questions. With a large push towards new apartment construction and steady outward migration from Connecticut to friendlier and warmer states, where does that leave the older stock apartments and single family home inventory, particularly in more rural towns?
In trouble. This thing, let's talk about it in two segments. With rural towns, let's make sure we're talking about rural towns. The apartment projects, those will probably, so long as companies are still employing people in those towns, though the employees of those companies will need a place to live, and the apartment projects in those towns will probably be okay. What we have seen, for example, in some of the more rural areas is a move to adjacent markets. So for example, in the Northwest Hills of Connecticut, a lot of the employees are living in Torrington or New Milford in apartment projects there, and they can find better product than they can find in, for example, Canaan or Salisbury or something like that. So, I wouldn't call Torrington or New Milford exactly rural. They're more suburban or semi-rural. But look, I think that's a concern, particularly if you have an older property. If you want to stay occupied, you ought to be looking hard at what it's going to take to keep the property up to competitive standards, if you will. We haven't seen a lot of this sort of new amenity-rich residential built in some of those markets like Torrington and New Milford, but I think it'll get there. Money is still looking for opportunities. They may not be 300-unit projects. They may be 150-unit projects or 110-unit projects, but I think they'll get to those markets because there's demand for it. The housing stock in those markets is like every other market. It's very old, the multifamily housing stock. On the single family side, I think, again, that's going to be a tale of two towns, so to speak. Some of the towns that are very rural and aren't driven by a big employer, that are driven more by empty nesters that are living, they've been living in Manhattan, but commuting to Kent, for example. That market's probably going to continue to be strong for the same reasons it's always been strong. But some of the other markets that don't have the advantage of being proximate to a market like Boston or New York City, I think we'll see slow migration out of those small rural towns. And if you've been following for example, the closure of maternity wards in some of these smaller communities, that's a sign of what's already happening out there.
Good point. We have another question here. In another presentation, the speaker indicated that upcoming mortgage foreclosures in the hospitality and restaurant industries will send us into economic chaos. Any thoughts?
You know, I don't think so. The activity level actually in purchasing of hotels, if that's what they mean by hospitality, I'm assuming they're referring to hotels.
Yeah.
The activity level in hospitality has been actually strong. It's coming back. And I think the reason it's coming back is, those with capital are looking down the road and saying, hey, by 2024, this will be a good asset to hold and I can buy it very cheaply right now. And we're seeing transactions like that occur. The hotel industry has always attracted a lot of that entrepreneurial money. Some of it money from overseas, China, India, Asia, Southeast Asia. The investors from some of those markets like the hotel segment in a big way. And I think you're going to see that money come back in because they have long-term faith in the US economy and the fact that people will get back to traveling. Now, if it's purely driven by roadside business people stopping in, I think that those will be the last to recover. If it's an old hotel, very old hotel, 20 years or more, they are in real trouble. And whether or not some of those can be salvaged, but in terms of falling into chaos with this stuff, I don't think so. The American economy is very resilient. I've been doing this for 40 years and I've never felt the need to get out of the business because of the cycles. There's been a lot of predictions and doom and gloom, whether it was when the savings and loan crisis hit in the late 80s, when the tax change occurred in 1986 on the dealing with active versus passive income. I mean, everybody has predicted the end of the world on that. But I mean, if you go into these tough times with liquidity and you're careful and you focus on the strong markets, I think you can do okay. Will there be a lot of foreclosures in those two segments? Sure, there will be. But I don't think it's going to put the economy into chaos. If we have any concern, it's interest rates. We want to see how the Fed deals with this interest rate issue, how strongly they try to cool off the economy. That concerns us.
That was another question that you just dovetailed to. So economists are now predicting 7 rate hikes in the next 12 months. How does this impact properties coming up for refi that have lost value over the past 24 months?
Yeah, I mean, that's we were talking about that. That's a huge problem. If they're talking about quarter point increases. So if there's 7 of them, you're talking about an increase of 1.75, 175, right? 175 basis points. So, I mean, that's going to hurt. Will it devastate a lot of these properties? Yeah, it'll devastate some, but I think many of them will survive. If it goes higher than that, then I think it's questionable as to what the impact will be. Long-term interest rates, if you go back 50 or 60 years, average out around 6%. When I started in the business in Canada, I was doing a project in Calgary, Alberta in 1982, and we were dealing with 22% construction loan money. I mean, insane, but we got through it. I mean, we got through it, and the project got built and everybody was happy. Crazy times, and I don't want to go through that ever again. But I don't think we're nowhere close to being up in that kind of stratospheric level. I think if rates go up to 6, 7, 8%, that's probably sort of a return to norm, if you will. It's going to hurt a lot of people. And as I said, I think we'll see some zombie projects and zombie developers out of that. We've had years of historically almost ridiculously low cost money. And I think if you've been in this business any length of time, you had to say to yourself, this isn't going to last,
Right.
It's got to change.
So we have a question from Tom Hill. He asks, Mike, what's your take on the resistance by DEEP to streamlining the Transfer Act per the Connecticut Working Group's suggestions?
My friend Tom Hill, nice to hear from Tom. I think that's a good question. I'm not sure I'm able to offer up an analysis of the politics behind why there's resistance there. Look, I think that there's no question DECD understands the need to improve Connecticut's status or the perception that Connecticut has in the investment world. And the folks over at DECD and the governor's office, I think, very much embrace the idea of doing everything we can using whatever tools we have available to try to improve the atmosphere. Look, I think as an industry, we need to keep the pressure up on DEEP to make these changes. The group that has been working on that is doing terrific work. I mean, I can't say enough about how good that is, that the industry has developed a group of people that have put that response together and are pushing it. And I think we should support it. Look, it's an election year. Maybe the advice we should give everybody, and Tom should use his radio show to push the folks to make some changes in this legislative session if we can get it done. That's usually not what this session is dedicated to, but they'll put these things on the agenda, especially if you attach it to improving Connecticut's economy. There's nobody that we run into out there, and we talk to a lot of them, who would argue that Connecticut needs to be doing what it can to improve our economic prospects. So now's a good time to push that.
Good point. We'll take one more question here. This is regarding real estate in the metaverse. Any thoughts on that? Any points on cryptocurrencies, Bitcoin? Oh
my gosh, I've sat through so many presentations on cryptocurrency, and I just can't look. I guess I'm a dinosaur, and I'll admit it freely, but I just can't get my head around it. It just feels so much like a Ponzi scheme. The metaverse real estate idea, I mean, it's a cool idea. If people like it and are prepared to pay for it, I don't see the value in it. It's not something we're going to get involved with, or other than to pay attention to what's going on. But look, all the power to them. If they can develop a product, if you can call it that, and get people to pay them for it, that's the free market system. I wish them well. I don't see there. I know there are stories for how companies can apply it, real estate in the metaverse. I've read a lot about that. We've been talking about here internally. We scratch our head on this kind of stuff all the time. I'm not there yet. We'll see. I'm willing to be convinced, but at the moment, I think it's an interesting idea and not much more.
Mike, I really appreciate the time today. Also want to
be here.
Thank you. Want to also thank our chapter admin, Bernadette, for putting this together. And lastly, just want to send a last reminder, April 18 through 21 is the 102 course date. And you can find information on our website at ctccim.com. So again, Mike,
if anybody has any follow-up thoughts or comments, love to hear them. My email's up on the screen, and don't hesitate to reach out. Thank you, Eric. Thank you, Bernadette.
Thanks again. Take care.